Hi there, welcome to our channel. Today, we're diving into a topic that can make a huge difference in your real estate planning, the step-up basis versus the carryover basis when it comes to gifting a home to your child. If you're thinking about passing on your property to a loved one, understanding these two tax concepts is crucial to avoid unexpected capital gains tax down the road. Before we dive in, why not click the little subscribe button right down there so you don't miss any more valuable estate planning tips we have coming up for you. I'm John Hurlbut, and I'm a certified real estate planner and probate real estate specialist. It's my mission to help you build wealth and, even more importantly, protect wealth in real estate. Look, we're all headed towards one final destination. It's not something we want to talk about, and we need to make sure that any wealth we've built that we intend to leave to our heirs is protected so we're not unwittingly leaving them with an unintended burden. Let's set the scene with an example. Imagine a parent who bought their home in 1996 for $90,000. Fast forward to today, and that home has appreciated to $475,000. The parent is considering gifting this home to their child in 2024 since the child has been unable to purchase a home of their own due to rising housing costs. But here's the important question. What tax implications does that transfer have for the child? Let's start by describing a tax concept called carryover basis. When a parent gifts the home to the child while they're still alive, the property's original purchase price, called the cost basis, carries over to the child. This means that the child takes on the parent's original cost basis of $90,000. So, if the child sells the home for its current market value of $475,000 now, or even if they live in it and sell it later at a potentially higher value, they would owe capital gains tax on the difference between the sales price and that original $90,000 cost basis. Okay, yes, I know calculating cost basis is a lot more complicated than what I've described here, so you internet trolls don't need to point that out in the comments. I'm just using this as a simple calculation to make a point. Here's what that looks like in numbers. Original cost basis in 1996, $90,000. Sales price in 2024, $475,000. Capital gain, $475,000 minus $90,000 equals $385,000. If the child's tax rate on capital gains is 20%, they could end up paying approximately $77,000 in capital gain taxes on that sale. And remember, this is just an estimate. The exact amount depends on their tax bracket and many other factors. And that tax would be due the next tax season when they filed their taxes for the year in which they received the home from their parent. That would most certainly make Easter dinner uncomfortable. Now, let's look at an alternative scenario with what's called the step-up basis. This is only available if the parent passes the property to their child as an inheritance after they pass away. With a step-up basis, the cost basis is adjusted to the home's fair market value at the time of the parent's passing. Let's say the parent passes away in 2029, and by then the home's value has increased to $550,000. With a step-up basis, the child's cost basis would reset to that $550,000. So, if they decide to sell the home for $550,000, their capital gain would be zero, and they'd owe no capital gains tax on that sale. Stepped up cost basis 2029, $550,000. Sales price in 2029, $550,000. Capital gain, $550,000 minus $550,000 equals zero. This can make a massive difference in tax savings, and it's one of the reasons why estate planning is so essential. And if they decided to move into the home and live there for a few years before selling it, depending on how much the home appreciated, they still may not owe any capital gains tax. I won't go into all the details here, but it's safe to say paying zero in taxes is far better than paying $77,000 in taxes, right? So why does all this matter? Because depending on the timing of the transfer, your loved ones could face a significant tax burden or avoid them entirely. Choosing between gifting now and leaving the property as part of an inheritance could result in thousands of dollars saved in capital gains taxes. This is what we mean when we say avoiding an unintended burden. You thought you were doing an incredible thing by gifting them the home now, and you were. It just came with a nasty surprise. Of course, this is a simplified overview and everyone's situation is unique. That's why I highly recommend sitting down with a certified real estate planner like myself to explore the options that work best for you and your family's specific goals. Estate planning doesn't have to be overwhelming when you're working with someone who understands the ins and outs of these strategies. Thanks for tuning in. If you have any specific questions about real estate or estate planning you'd like to see me cover here, don't hesitate to reach out. I'd love to chat with you about it and answer all your questions. Who knows, I may even give you a shout out in the next video. Catch you at the next one.